Hi, everyone. Good evening. Thanks for showing up tonight. I'm Debbie Schwartz, founder of Road2College and the Paying for College 101 group. And I have tonight Chris Abkarians, who is one of the co-founders of a company called Juno, which he'll tell you more about. So let me just do a little housekeeping and then we can kind of get to the meat of the discussion tonight. This is technically a Facebook meeting as opposed to a webinar. I just say that because you can unmute yourself, which you really might want to do tonight, and I'll tell you why. And you can put your video on, which you don't have to, but it's nice to see people's faces. We are recording this, so you can get the recording tomorrow. But tonight is actually just an AMA, Ask Me Anything, Ask Us Anything. So we don't necessarily have slides. We can talk about lots of different things, but we really would love if, people have questions about loans, about the process, about, private loans, federal loans. We can, try and answer as much as we can. And feel free to unmute yourself to ask your question, raise your hand. There's like a virtual hand capability to, put your question in chat. We're really, this is kind of like just an open discussion about loans because it's that time of the year, or that time of the summer when most people have their tuition bill and they're, and even particularly this year, there's not that much time between when you get the tuition bill and when you have to, have some plan about paying. And there's just a lot of, natural questions that come up. And if you're willing to ask your question, share as much of your situation as you feel comfortable, but then a lot of times people will learn from it and they'll kind of add on questions. So that's the goal and the purpose for tonight. Before we actually even get to some questions, if you don't mind putting in the chat kind of, where you're Zooming from, if you want to share where your student is going to college, that's great. And if you want to start asking questions or just kind of like tell us how much research you've done already on loans. And Chris, while people are doing that, if you want to give a little background on yourself and Juno.
Sure, happy to. And thanks for arranging this, Debbie. My name is Chris Abkarians. Thank you for being here tonight. I'm the founder of a company called Juno. I started about 6 years ago with a few of my classmates at Harvard Business School. And our goal was to see if we could band together a few hundred of us who needed to get loans at the same time and approach various banks and credit unions to ask if they'd give lower rates and special incentives to a larger group, as opposed to each one of us applying to those places alone. Over the last 6 years, we've now helped about 192,000 people who've signed up on our site. Juno's free. We don't charge anybody anything. If anybody needs one-on-one help with anything related to loans, federal or private, you can go on our site and book time with an expert on our team for free. If there's anything we can help you with at all, please do not hesitate to reach out. We're glad to be here, and we've probably seen almost every iteration of a question that could happen, although there's always a new one we hear on one of these calls. So I look forward to seeing what we can learn.
Great. Well, somebody mentioned that they couldn't hear me well. I don't know if other people can share if they're having any problems hearing us, or maybe it could just be the other person's settings. So just let me know. Okay, I can hear you both. Great.
You're loud and clear.
Thank you. Thanks so much.
Thank you.
Okay, so people have already started putting questions in. We'll go through these questions again. If people want to interrupt, that's fine. I see Damon has already unmuted yourself. Do you want to say something or ask
Hey, Debbie.
Hi.
Hey, Debbie. Thank you so much for providing this service. My question is about timing. Can you talk to us about how quickly we need to get the loan and when the college bills are due, how they're paid?
Yep.
Happy to take that. Damon, each school has a tuition due date. It's a little bit different for each one. It's typically around when classes start. So I can even look it up for you kind of while we're on this. But in general, I'd say if you're going for federal loans, make sure you filled out FAFSA. If you haven't filled out FAFSA yet, do it really today or tomorrow. As of right now, the school would get the information back in about 3 days, sometimes up to 5 days. And once they do, as long as you'd qualify for either of the two federal loan programs, which I'd say high likelihood that you would, then there's a really simple process on the FSA student aid website where you can just click some buttons that allow you to opt into using those federal loans. If you're thinking about using a private loan, the process is a little bit different. So as long as you're applying a few weeks before that tuition deadline, then in most cases, you should be okay. You would check your rates on like wherever you'd want to check them. Most lenders at this point have something called a soft rate check tool. It would take you about 5 minutes to input some basic information. There would be no hard credit check, and you'd see a range of rates you'd qualify for. If you like any of those, you'd submit a full application. That would take about another 10 minutes. At that point, a hard credit check would be done, and if you're going to be approved, you'd find out either the same day or typically within 2 business days. And so think of it as probably about 20 minutes of work today, and max, in most cases, 2 days from now when you'd find out what the status is. And then if any of those are something that you want, you would digitally sign it, and then the ball is sort of out of your court at that time. The school would get a message from whatever the lender is, simply asking if your student is going to their school and if the amount they want to borrow is less than or equal to the cost of attendance, which is, in short, tuition plus living expenses. The school would say yes to the lender, and then they would just tell them to wire the money on the tuition due date.
So are you concerned that you don't have enough time, or you just wanted to understand the timing?
Not anymore. I got plenty of time now, and I'm heading over to Juno.
Okay, great. Because
Thank
some
you.
people, I mean, and honestly, sometimes that type question comes up where people, have waited a little bit, maybe to the last minute, or other things happened and they didn't realize they needed a loan, and they don't know if the money will get to the school in time, and particularly like from a private lender. And so I'm just putting this out there for other people who might run into this problem. If you're approved by the lender, but like the school hasn't finished their process, because every school, as you probably found out from the admissions process, does things differently. So every school, pulls or gets information from private lenders to do the verification in different batches. But usually you can still reach out to the school, say, I've been approved for a private loan. They might ask you for some information, my student wants to start school, and basically they might kind of like fiddle with it all, and your student can still start even though the money might have come from the private lender yet, because they know it's going to come. So I'm just throwing that out there for anybody who might run into that situation. Okay, how about Amanda? You want to unmute and ask your question?
Oh, I do. Thank you. And thanks so much for these webinars and opportunities, Debbie. They've been so amazingly informative and helpful.
Great.
Let's see. So my daughter qualified for the federal loans, and so we're doing that. And then there's enough money in the 529 to cover the first semester of tuition. So for the second semester, we will be applying for a federal loan. And I understand that interest rates are expected hoping to drop in September. And I'm wondering what your thoughts are, Chris, on like securing the loan, but not taking the payout just once rates drop, sort of how to be strategic about that, if that makes sense to do that.
A great question, Amanda. So because you're looking at federal loans, the rates that you'd be offered for the spring would be the same as what you would secure today. So the way pricing on those work is once a year, rates for the following year are set. That typically happens in early May. There's a formula that Congress set up that sets this up, but I won't go into that now unless people have questions later. But for now, what you should know is whether you're getting a loan for the fall or the spring through federal loans, the rate on what the student can borrow So the direct Stafford loan is 6.53%, and the rate on Parent Plus loans is 9.08% plus about a 4% origination fee. And that's going to be the same rate no matter when you take the loan, all the way through June 30th of 2025. If you need to use a federal loan for the following school year, then there might be different rates for those, and those will get set at some point in May of 2025.
Great, thank you. And how about if we also need to take a private loan in addition to the federal loans? So what could you say about that?
Sure. So I can't predict what direction rates will go in. Every time I try, something else happens. What I'd say is that there's, for any private loan, I'd say one of the things to know is that if you applied for a spring private loan now, so in the application, you can select if you want a loan for the full year, just for the fall, or for the spring term. If you, let's say, find a rate that you like today, you lock that in. If we get to, let's say, January, and rates have materially dropped, then you're actually still allowed to cancel that loan and get a different loan at a lower rate at that point in time. So to some degree, if you wanted to lock something in right now, it's kind of like adding an option that you are not obligated to use. To some degree also, that September rate cut is kind of already priced into the rates you're seeing in front of you right now. So I don't know that things are going to materially change, but they might. So there's the downside of trying to lock something in today is that you would get a hard credit check conducted today. The upside is that you have this additional option of the worst rate that you could get.
Got it. Thanks so much.
Sure.
And the other thing I just want to highlight about what Chris just said is at any point, if you have decided on a lender and you've chosen your loan, you can change your lender if, let's say, you find out about a different lender that you didn't know about before, or you do you check rates with Juno and they can get you a better loan. As long as the money has not been dispersed from the lender to the college, you can cancel that loan. So just something to kind of keep in mind, that it's not a done deal until the money leaves the lender and goes to the college.
Okay, and the private loans don't have origination fees, right? Is that correct?
The vast majority of them don't today. So if you run across one that does, I'd be cautious. Currently, none of the major lenders have an origination fee, and there's also no prepayment penalty. So even if the money was already dispersed to the school and you decided that you didn't need it or you didn't want it, you could effectively prepay or just give the money back. And the only thing you owe is interest that accrued during the time that the money was dispersed, which if you're making this decision, depending on when you're making it, it's probably only a few days worth.
Thank you.
Okay.
Sure.
How about Risa? You raised your hand.
Hi, thank you so much for this opportunity to come on. We have two older kids that went through the college scenes, and we were right with them. They took out the federal loans. I think it was like $5,000 was the max, and then they took out private loans. Now we have our third child who's 14-year difference with the older child. So this is a brand new process with us. So with the federal loan, is it only a $5,000, or can you take out more? And then we have to jump into the private loans. And I did put in the chat if you can explain what Juno is, because we have no idea what Juno is.
Sure.
We're uneducated. Two of my friends actually texted me, "What is Juno?" I'm like, I don't know. And then we've been getting some information about, what was it, College Ave. We started looking at the different rates that you provided to in one of the emails. Now they say that the APR, whatever it is like 4.5, but then it can go up to 17%. Like how do you decide which one would be good if it's low, but then it may go high? So we're kind of need help.
Great questions.
Great questions. Let
Thank
me,
you.
and thanks for the questions. Let me break down three things. And then if I haven't answered everything, please do let me know. So
Okay, thank
first,
you.
let's just start with the borrowing amounts for undergraduate student loans. So your student is able to borrow for the first year of college $5,500 from the federal government.
Okay. But
And
it's still
so
5,000.
yeah, so it's 5,500.
Unfortunately, those limits haven't changed. That's like another conversation, but yeah, from
Right.
14 years ago.
Yeah, exactly.
And so that 5,500 that they can borrow for the first year is at a 6.53% interest rate. And it's actually, I'd say it's still a really good loan overall, because it has a lot of protections built into it. They can tie the amount of their payment to their income after graduation, and there's some other protections that exist with it. Now, there is another loan option that you can use from the federal government. You don't have to go to private loans if you used that 5,500 and you need more money. The other option is called Parent Plus. Now, that you also get by filling out FAFSA. It's a loan that you take out for their school. The rate on those is quite a bit higher at about 9.08% plus a 4.2% origination fee. And if you get to that point, that's when it might make sense to compare that rate and fee to what a private lender might be able to offer you. So to kind of bring that into the second question, that's where Juno comes in. So what we do is every year we aggregate demand from thousands of parents and students who want to get or think they might need loans for the upcoming academic year. And we talk to a bunch of different lenders to say and ask who would be willing to offer us a better product than what they generally make available to members of our group. Signing up to our group is free. We don't take your payment information. We literally don't even have a mechanism in our forms to accept your payment information. You can kind of just think of us as kind of like a Costco for student loans. So for undergraduate student loans right now, what's a little bit different about Juno versus going directly to some lenders is we have a main partner lender. You can check your rates on our site without impacting your credit. If you if you like the rates you see and you sign a loan, then you get a 2% cash back on your loan amount. So on a $20,000 loan, for example, you'd get $400 cash back on that. And then if you find a lower rate from another lender, including College Ave, for example, then we have a really simple process where we can match that lower rate and increase your cash back to 3% instead of 2%. So really, we just tried to set up a process that was meant to build some trust that we could help you get the lowest rate. And that if we weren't offering you as the lowest rate, there's a simple process to make sure that we hold true to that promise and are able to honor that. And to bring it to your last question, what's up with those rate ranges that get advertised all over the internet? So when you see something like 4.5 to 17% as the advertised rate range for a given lender, and most lenders give you a range that's somewhat similar to that, that doesn't mean that your rate would start at 4 and it could go up to 17 over time. It just means that you have to still apply to check what rate you might be eligible for. And the rate that you might be eligible for could be anywhere within that range. They're only required to publicly disclose what the lowest end of what they offer is and what the highest end of what they offer could be. I would recommend trying to check your rates on places that don't require you to do a hard credit check, so that you can at least get a good sense for whether you're qualifying for something that is lower than that Parent Plus loan rate. Because it doesn't make very much sense to use a private loan unless you're saving money against that. And one place you could go to accomplish that is a site called credible.com. That's CREDIBLE. And that would let you get rates from a number of lenders, including College Ave, without doing a hard check on your credit.
Okay, so getting back, so my son, he graduated 4 years ago. He took loans out through Discover. Discover was a cashback, which he put that cashback money back into his loans to help with the interest. Discover does not do that anymore. What other sites do cashback? Because that is so important to get that money paid back onto the loan. And the other question is, should we take out the money for the whole year or a half a semester so we're not paying back that interest rate? Because I know like she's going to be taking out the loan in her name just so she can get the credit. We're paying for it. But and I know after 4 years, that's when she's going to start paying back. So is it better to pay the whole school year term or do semester?
I'll start with the second question. So the money is just, so if you applied for a loan for the full year, then the money is actually dispersed evenly across each term. So if it's a quarter system, typically across 3 terms for a normal academic year. For a semester system, half of it would be sent in the fall and half in the spring. You don't start accruing interest on any sum of money until it's actually dispersed or sent to the school. Meaning if you, all else being the same, if you applied for a full year loan first, 1 semester now and 1 semester again, let's say in December or January, as long as the interest rate was the same, nothing would change in the amount of interest that you're accruing. So I'd say don't worry and go with the full year. And then regarding the cashback portion, some lenders do offer as promotional periods, sometimes a 1% bonus that's associated with maintaining good grades or graduating. At the moment, besides what we're offering through Juno, I believe there's one other company that does a 1% bonus, at least as of a week ago. It's Abe Loans, ABE, like Abe Lincoln. I don't know for sure if it's still happening, but I know as of relatively recently they were as well.
Yeah. So, fortunately or unfortunately, I don't know which side of the loan you're interested in, but Discover got out of the student loan business pretty recently. This is the first year that they aren't in it. It's a long story. They were also purchased by Capital One, so there might be issues. There might have been some agreement there, but so that's why they're not in the business anymore. Yeah, the only other kind of discount that I know of is when if you do direct deposit or direct payment, you will usually get a slight interest reduction when you set up the loan. So that's just something to kind of consider. I think it's like a 25 basis point reduction. And the other thing I will just kind of emphasize kind of from your question and the answers that Chris gave is that everybody here, if you need to borrow, your students should be absolutely borrowing the federal direct student loans as the first step. I mean, nobody, hopefully, who's credible in the loan business will tell you to go straight to a private loan. Every student, if you need to borrow, should be maxing out whatever they can get from the federal government. That's a student, it's called the student direct loans. And the reason for that is because it's in their name and it's the lowest interest rate that the student will be able to get in their name without a cosigner. And then all the protections that Chris mentioned. So that's like a given, that's step number 1. And then if you need to borrow more, that's kind of where we are encouraging you to shop around, just like you would shop around if you were getting a mortgage rate. You would go to several mortgage lenders and you would see what they're going to offer you, and then make your decision. It's the same thing with student loans. And one of the reasons over the years we've partnered with Juno is, and Chris I'm just going to clarify because we get this question a lot. Juno isn't a lender, but they've negotiated on people's part with and picked a lender that is trying to give you a better rate than you might have gotten from other lenders. And the reason why we encourage you to shop around is obviously, see what different lenders are going to give you. And there will be a range because every lender, has, even though they probably look at similar things. They all have their special sauce about, you know, how they're gonna calculate your riskiness and what rate they're gonna offer you. So it will definitely vary. And then you can kind of know that whatever rate that Juno can offer you is either, you know, better or you're not as good as other rates. So you have a comparison. So that's kind of, you know, why we so strongly encourage the shopping around and why we think that, you know, Juno offers a great service, because they are trying to beat whatever that you've been able to find on your own.
Okay, I have one more question. You talked about soft credit checks. Can you send us via email what companies are do soft credit? Because we rather have a soft credit than a hard credit check.
So,
Good.
okay. I mean, we can talk about which ones. I mean, so this is just my quick opinion, and Chris, you can definitely chime in. Where we are in the season, this is like July 23rd. I would imagine in the next month, you're going to have to make a decision and make a commitment to, you know, a lender if you need to borrow. If you're truly going to take a loan, or if you want to know an exact rate, you have to do an application and a hard credit check with a lender. The soft credit check, which is definitely valuable, and probably a little bit more valuable at earlier times in the season, will give you will narrow the range of the interest rate that lender will give you. So if you've already seen, it's 4 point something to 17 something, you know, if you do a soft credit check, they will narrow that and maybe say, you know, we can offer you between 5 and 9. So it definitely kind of, you know, gives you a better sense, but it's not going to give you an exact number. The only time you're going to get an exact number is when you do the full application. And so the only reason I'm explaining all this is because, you know, I mean, you can do soft credit checks. Honestly, most lenders these days, I don't want to say all, but most will offer it directly on their site, and Credible offers it for a lot of them, not all the lenders, but a lot of it. And if you do a hard credit check at one lender, you have 30 days to shop around and go to other lenders who might do hard credit pulls. So you have the chance to do this shopping around without getting like dung or dinged for a second time, you know, on your credit report if you want to have multiple lenders do a hard pull on you. And that's the credit bureaus. The credit bureaus also know that people should be shopping around, so they want to encourage people. And so they kind of say, you have this 30-day period. We know if you've asking for a rate on a student loan that you should go to other lenders. And so, so I just say all that because you're getting close, or you know, to when you might need it. So you may or may not want to go through the soft credit check when ultimately you're gonna at some point want to do some hard credit pulls. So just something to think about.
Thank you so much for helping us out. Thank you.
Chris, was there anything you wanted to add, or I missed?
Quite comprehensive, Debbie.
Okay.
Thank you.
Okay, sorry, we got a lot of hands up. Paul Paul S.
Yes. Hey, thank you, Debbie and Chris, for taking our questions. So my daughter has a partial athletic scholarship, and she needs to apply for the remainder of the cost for her first year of her master's program. The athletic department is covering her tuition. How does the money land in her account to pay for room and board?
Great question. So I'm going to broaden this answer to any scenario where the amount that you're borrowing is beyond what's needed to pay for tuition and mandatory fees. So say for your specific example, let's say the amount that's being in her fall bill, the required payment to the school is probably 0. And then there's an incremental amount that you want to borrow for living expenses. So whatever amount you borrow is at first sent to the school, and then the school typically opens a separate bursar's account for the student that you can log into and then wire that money to a personal bank account to use to pay for any living expenses. And a little bit more broadly, for anybody else who might be in a similar situation, if the amount that you're borrowing is greater than the required tuition and mandatory fees for that term, then the same thing applies. The full amount is always sent to the school. The school subtracts out what's required to pay on the tuition due date, and then the overage is you're able to log in and wire that to your personal account to pay for rent and books and anything else.
Excellent. Thank you.
Sure.
Okay, Risa, you want to ask your question?
Yes.
It's not me. I think
Wait.
there's another Risa on
There-
the line.
Yeah. How many times do you get two Reeses in one meeting?
Right.
Oh, really? Hey, I was brought up with so many Risas, so it's very nice to meet another Risa. Like my seventh Risa. What state are you in, Risa?
New York.
Oh, we're not that far. I'm in Cherry Hill, New Jersey. We're pretty close.
All right. So is this my question?
Yes, go ahead.
All right. Thanks. I have money in 529. My son is 24. He'll be 25 in September, and he's starting grad school. I'd like to know pros and cons of him taking a student loan. He wants to build his credit. And I know that ultimately the loan will be paid back from the 529, but pros and cons of him taking a loan.
It's a good question. And this does come down to just a little bit of personal preference. The student loan isn't the only way that they can build their credit up. So there's a minimum loan amount that can be taken out. It varies by lender. For some, it's $1,000. For some, it's $2,000. If the goal is really just to build credit and there's enough funds to pay for the school, then it might really just make sense to take out whatever the minimum is, and to use that as a decent way to add an installment loan on his credit, because that does actually improve his overall credit score over time. But beyond that, I would shy away if you're able to. I think it would be optimal to avoid accruing the interest that you don't need to pay. There are other credit builder products that you could potentially use that might be a little bit cheaper overall. So I might, Debbie, I don't know if you have something else you'd like to add on.
I don't have names off the top of my head. I mean, I know of like some companies, but honestly, I would Google credit builder, products. They are out there absolutely aimed for this age category to, do exactly what you're trying to, or your son's trying to do. And to just echo what Chris said, there just might be easier ways if that's what your true goal is in taking out the loan. There might be better ways and easier ways to help build up his credit.
Okay, that's really helpful because he surprised me with this. I was just ready to pay it right from the 529.
One that I know that some people have used is there's a credit builder loan from Digital First Credit Union. I think their logo is DCU. And it's like I think a 1 to 2 year term loan at 5%. You take out minimum 500, I think up to a little bit more than that dollars, and that it's structured so that it has a very low rate for a loan, and it's really just meant for this purpose.
And another company, to tell you the truth, is College Ave. They are a lender, but they also just came out with a product. It's called the Ambition Card, and it's basically another way that companies help young adults or even people who have to repair their credit is with what they call a secured card, where you're actually kind of like putting a deposit down of a certain amount, and then you're using the card, but they kind of have collateral so that they know that the charges are going to be paid. So College Ave has this Ambition Card. There's other companies that do that type of secured card product.
Okay, wonderful. Thank you.
Yeah, no problem. Okay, how about Craig?
Hi, the question I had was, are you allowed to make apply to principal payments on a student loan? Whether federal or private. I would imagine private you would be able to, because that operates like kind of like any other loan, but can you do that with federal?
Yes, you can. with both federal and private loans, there's no prepayment penalty. So you can apply the overage on an additional payment you want to make directly to the principal. And so if you're in the position to do that, it can certainly help.
The only thing I'll add to that about the federal is you have to wait, not that it's that long, and your student needs to go in and into their FSA account or and see who the servicer is that has been assigned to their loan. And then you need to reach out to the servicer to find out their process or their notification to tell them that you want to apply, you know, the payment to principal. So it's just a few extra little steps. People don't always bother to figure out who their servicer is because they're not paying the loan back immediately. So this is something to be aware of, how, like, the actual tactics of how you would tell the government who you really have to find out who the servicer is, that's what you want to do.
Got it. Thank you very much.
Okay, how about Natasha?
Hi, so my question is in regards to the additional loans that we will need to take out, student loans that we'll need to take out. So we have funds that were in a 529, which I now have in a savings account. So majority of the first semester will be paid for with the 529. So my question is, if we take a loan out for the whole year, can we say to the lender, either Parent Plus or, Parent Plus or private, that we only need, for example, 5,000 of the 25,000 this year? This semester. And so then the remainder of it would be sent to the school for the spring semester. Or should I just, I guess, divide what we have in the 529 by 2 and pay, half of it for the first semester and then get the loan for the remainder, and then just make sure I pay for the second semester this year so that I won't incur any penalties on the money that we've already taken out of the 529 account?
This is a great question. I think the first strategy you laid out might be a bit better for you, because you can reduce the amount of interest that you're accruing for a shorter period of time. Now, when it comes to having disbursement that are uneven, that's where things get a little bit complicated. Sometimes it's easier to just apply for 2 separate loans, one for the 5K for the fall and then the remainder for the spring. If the other alternative is that you can email the school's financial aid office and ask if they would be willing to certify 2 different amounts for the fall and the spring. So I'd say most schools tend to be receptive to this because there's part of the process is what I was saying from the beginning, that the lender has to reach out to the school and ask if the amount that you want to borrow is the right amount. And if the school overrides that and says, actually, for the fall, this is only going to be 5,000, then the lender doesn't, they just accept that 5,000 and that's the amount you have for the fall. So really either of those 2 paths is probably the best way forward.
Okay, thank you.
Sure.
Okay, how about iPhone Lori? That's the name on the screen.
Hi, Debbie and Chris. I think that's me. I just want to confirm, because I just want to make sure I understand. So for federal, like if you're going to do Parent Plus, I understand that you might as well just apply, for the full year, because it's going to be the same rate. But if you're going to go private, maybe it's better to just take out the amount for fall as opposed to the entire year and then apply again in January for the spring, because rates may change. Or I just want to make sure I'm clear on that, because I wasn't really sure if I should take out just the full year, get it over with. So if you could just clarify on a private.
Sure. Look, it's a good question. The way I think about it is, if you take a full year loan now, only, again, half of it is going to go in the fall unless you ask for it not to be. And the second half is going to be dispersed in, for example, January. If it comes to December and you notice that let's say you've applied for a full year loan and that's the scenario you're in, you still have the right to cancel the second half of that loan at any point over the next couple of months. So it might make sense to just apply for the full year now, and you can check what rates you might be eligible for again in December. And you can do a soft check if you don't want to get a hard credit check at that point. And if you see that the rates that you might qualify for are different than what you currently have, then you can, the order of operations actually would be, it comes to December, do the soft check. If you have a lower rate through the soft check, submit a full application and make sure that you're actually approved for a lower rate. If you are for sure approved for a lower rate, then you cancel the second disbursement of the loan that you signed now and take that new lower rate and move forward with it.
Okay, got it. Thank you so much for explaining it. I was very
Sure thing.
confused.
No
Sure
problem.
thing. Happy to.
Okay, how about Leslie?
Hi, thanks so much for taking my question. This whole session has been great. I do have a question around the Parent Plus. I was told that after the Stafford, if you need additional funding, the Parent Plus is the way to go before a student-only private loan. And I'm not sure of the reason. Is there a benefit? Is there maybe something, I was thinking maybe in line of potential forgiveness in the future, but I don't even know if that's anything to even, consider or make part of the equation. So is there a real benefit to Parent Plus, or should the loan, should you just jump to a private loan in the student name only?
So there's the one thing I would clarify here is that about 98% of private loans are co-signed between the student and the parent or another creditworthy adult. So there are very few student-only private loans that happen for undergrad. There are many more that happen for graduate students. So assuming this is an undergraduate conversation, that I'd say the advice that you got is accurate, because it's highly unlikely that a student only qualifies for a private loan, since they typically don't have long enough credit history. Now, I'd say that the trade-off to consider when you're deciding between a Parent Plus loan and a private loan is, at least in my mind, are you able to qualify for a private loan rate a co-signed private loan in most cases, that is lower than the rate that you'd get through Parent Plus rate plus the origination fee? If so, then it can make sense to consider a private loan. If not, then I would just stick with Parent Plus. Now, there are some additional, I'd say, safety net benefits that are tied to a Parent Plus loan. And there are some scenarios where you can tie the amount that you'd pay to a percentage of household income. The level of protections that are built into Parent Plus is, I'd say, a lot lower than the protections that are offered to the first $5,500 that the student can directly borrow from the federal government for their first year of school. If helpful, I can send you kind of like a summary list that goes through exactly what the benefits are on a Parent Plus loan, but generally that's the framework I think through.
And
Okay.
just to kind of make sure you and other people understand, the Parent Plus loan, obviously from its name, the parent is the only person who's financially responsible for that loan. So I guess I just emphasize that because that is a kind of a financial and philosophical decision that you need to make. Do you want your student to have some responsibility? I mean, you can have some other internal, family conversations that they are responsible, but legally, you as the parent is the only person responsible, versus a private loan. And again, I'm not pressing one way or the other, but just to kind of understand the distinction, it is both the student and the cosigner who would be responsible for the payments and paying back the loan. So that's one thing. The second thing is, I don't have the exact number, but just to give you an estimate, when you factor in the cost of the origination fee plus the interest rate itself on a Parent Plus loan, it's a little over 10%. So that's the number you need to be using if you're comparing interest rates against any interest rates that you might be getting from private lenders. So just kind of keep that in mind as you kind of gathering all the information and you're making your comparisons.
Okay, I think, I just looked at some notes. They did mention a death benefit, but I have to imagine then you're taking the loan out for 30 years with, because the person said you put it in the name of maybe the older parent or the parent who may have comorbidities or something. So in other words, the loan dies with the parent.
That is true.
Okay.
I mean, I don't know your age. I mean, and in some,
Yeah, I'm not that old.
right, in some strategic situations, it's sad to say, but we've, given this advice to a parent who might be terminally ill. And it does make sense for them to take out the Parent Plus loan. So for the reasons that you just mentioned.
Okay. Thank you. Thank you so much.
Okay, Lily?
Hello. Thank you so much for this opportunity. Maybe, I don't know, because it's the first time I'm parents of somebody goes to school, and I don't have any experience about that, not at all. It is my first question. When my daughter is in her second year, she's sophomore student, and she paid for first year by herself, everything that she had in saving. But I actually want to help her. But as you talk about for previous question, I don't like to say I cover all of them. And I really like to do that for her responsibility for about any kind of the loan. My question is, because I didn't apply for any kind of loan yet, I just wait for federal loan that she applied by herself. But first question is, when we want to apply for any kind of loan, is it better that she applies for that with the temporary job, or and I sign as a co-signer, or is it better I go for apply for any part of that? Because it's really matter for me. I need my credit score, and because I have planned for them for investing.
Whether the student starts the application or you start the application for a co-signed loan, the application will only fully submit once both of you complete your portion. So it won't necessarily matter who starts it. I hope that answers that question. Yeah.
Okay, thank you. Thank you so much. And
Sure.
Do you think when we do that, it's something both are involved? Yes?
Yes.
Okay.
Correct.
And thank you for.
The only other thing else, there is a type of loan called a private parent loan. And that is for the parent who might want to have full financial responsibility for the loan and feels that they can get a better rate, by doing a private loan as opposed to a Parent Plus loan. But it does, so that's the only other type of loan if you were, or a parent truly wanted to be, but I have to tell you, in all honesty, and lenders have told me that even though they have that as a product, most times the parent and the cosigner, like the true student loan where the student is involved and the parent is cosigner, they tend to actually get a lower interest rate because there are two people on the loan. So
oh, perfect. Thank you. It's really helpful. Thank you.
No problem. Okay, Bailey, do you want to ask your question?
Yeah, thank you so much for taking my question. I have two super quick questions. The first one is, can you just accept the subsidized federal loan? Like, do you have that option? And then the second one, I'm not sure if you'll be able to answer, but if a parent's employer, part of the benefits that they reimburse like a set amount of tuition. It's not a lot, but a little bit. How do scholarships and grants get applied to the student's like bill? If the employer only reimburses quote tuition, can those scholarships and grants be credited toward the room and board portion? Thank you.
A little bit of a tough one because it depends on how the employer is going to define the
Reimbursement.
reimbursement, what
Uh-huh.
that applies to. One way to, honestly, part of this is a guess, but this is maybe the framework so that you can start heading towards asking the right question, perhaps of the employer. So when a school publishes how much it costs to go there for the year, that number is called the cost of attendance. That is the tuition plus the fees plus room and board and living expenses. And for the purpose of loans, the amount that you're allowed to borrow is at most the cost of attendance. And then if you get scholarships, then those are supposed to get subtracted from that amount. So if you started with $50,000 and then you got $20,000 of scholarships, the amount that you can borrow is now $30,000. So to some degree, the way the school would report the amount of money that you're required to pay, they wouldn't show that this money is being deducted from tuition. They would actually just show that it's being deducted from the cost of attendance. And so as long as the employer is that sees, let's say, a number, the cost of attendance, which another way is your bill, that's higher than your tuition amount, and they're willing to accept that for the purpose of how much they'll reimburse, that might be the way to approach asking that question. I hope that was clear.
Yes, thank you.
Sure.
Okay. Leslie, did you ask your question or maybe not? Sorry, I lost a little track of.
Yes, I did ask my question. I did really quick. Do you have any thoughts on state agencies as loaners? I have a friend who said, oh, Rhode Island has great rates. You should take it out from Rhode Island, even though my child doesn't go anywhere in Rhode Island.
A lot of state agencies are pretty fantastic. And so, yeah, I know Rhode Island has Riesla is their lending product. Texas has one called Brazos, so which applies to anybody who's going to school in the state of Texas, regardless of where they're from, or any Texan who is going to school in another state. And Juno has a pretty close partnership with them as well, where we have some added benefits for using Brazos through Juno. And I think people who are still getting rates in the 3 to 5% range, a little bit higher in some cases, but they're a nonprofit-based lender. So I'd say there aren't many of these state lenders. Brazos is the one that has the best overall rate. So if you have any nexus to Texas, definitely check them out through Juno. But because many of these are nonprofits, they have a cap on how high they can charge, and they can often result in a great outcome.
Great. Thank you. Thank you so much.
Sure.
Okay. J4.
Yeah. Hello, this is Joe. Thank you. So I'm just trying to make sure I understand. We'll just say each year. Does any of these lenders do like I call it the rolling loan? So every year you're just growing the loan versus every year having to apply for a new loan? Because 4 years is 4 years, and we do have 529 money, but there's still a gap, and he knows that he has to have skin in the game on this one. So we're willing to offer the first year with the private loan, but after that it's kind of part-time job. He has to kind of contribute a little bit to make sure, like we said, skin in the game to earn it. It means more than the grades and stuff like that. And the program he's in is at Purdue is a 99% placement. So I'm not worried about after graduation. It's just affording each year as an out-of-state it's funny, their tuition is the same cost as my in-state for him. So go figure that one. So that's kind of what I'm trying to understand is the rolling. Are we going to have to do a loan year versus just, I call it the add-on, kind of like how the federal loans, you just kind of keep adding that at the end you consolidate and have one big payment.
Yep.
Yeah. So maybe let me take a stab at this, and then Debbie, if there's anything I've missed, please let me know. So for federal loans, you do need to fill out FAFSA each year in order to qualify for those. And each one of those shows up as a separate loan on your credit report, and then you can consolidate them upon graduation. Private loans are kind of similar, actually, in the same way, in that you do need to apply for a new one each year. The rates can change from year to year, and in many cases, people might switch which lender they use from one year to the next. At the end of the process, though, once the student graduates and has a full-time job, similar to how you can consolidate federal loans, you can also refinance and consolidate private student loans, which is relatively common. So refinancing a student loan is actually a little bit simpler than doing it for your home because there's no fees associated with it. You're typically able to, let's say, once they graduate, do a soft check to see what refinancing rates they might qualify for, and then roll the 4 separate undergraduate private loans plus federal loans, if you wanted to include those, into one single larger loan at, depending on what the rate environment is like when they graduate, hopefully a lower rate.
Okay, thanks. I just didn't know based on we'll say by year 4, the open loan. I'm trying to see if the debt to ratio really affects by year 4 with the private loans.
It'll kind of, yeah, the debt to income ratio could impact eligibility, but it's going to really depend on, I mean, if I'm not mistaken, and don't hold me to this, there was a report I saw that the debt to income ratio cap for most private lenders was around 40 or 42%. And so in case that is helpful, maybe if you are able to project out what the likely debt to income ratio would be by year 4 and see, hopefully you're well below that cap. And I think at Purdue, hopefully you might be, because I know they've done a really good job with their tuition overall. But
yeah, I'll just say it's like 41K out of state, which is low compared to UVA and Virginia Tech, which is about the same in state.
Yeah.
So we're just trying to, we know how much we can contribute, but if we take on, 10, 15K a year by year 4, because we barely qualify for unsub, I guess, or I guess everyone qualifies for unsub, but and we'll take that. But yeah, this whole plus and everything else, I think, has helped everyone, and I do appreciate it. And I know there was a question in the chat about do parents do joint loans, or is it either or parent?
Typically it's either or parent.
Okay.
Right. Yeah. So, and that might be a way that, if people are concerned or hitting up against like a debt to income ratio, they trade off the parent who's going to take out the loan each year. I just wanted to add, you might have seen there is one lender that offered what they called a multi-year loan. Personally, if you read the details, it's a little bit of a marketing gimmick, I think. Not bad, but it basically, they are kind of trying to ensure that you will have the money for 4 years. It is still technically 4 separate loans. I think what they might do is kind of like approve you so that they can say, we will, approve you every 4 years, but they are still giving you a new loan every year because they have to give you, a different interest rate, because you can't lock it in the interest rate for 4 years. So that just might be something that you've seen out there, and might have been either
Maybe
what
that's
you.
what I saw.
Yes, yeah.
And I just wanted to, I'm trying to understand this because for us, it's August 19th is payment due. So we're in that final push. Just trying to figure it all out, I guess, because I think this week is housing. So there's the other big chunk of cost of not, that will finally be defined. It's been unknown since all summer. So I just cross my fingers he's not in the most expensive housing.
Right, right.
Thank you
Okay.
for your
Sure.
time and assistance.
No problem. Okay, there's somebody, it just says iPhone, so don't know any other name. I don't know if anyone knows if that's them.
Maybe me?
I think so, yep.
Oh, hi. My name is Nancy. From Illinois. And Debbie, thank you. I've been following your Facebook group, and it's been so helpful over the years and listening to parents and their stories and suggestions. And I have a question about the federal unsubsidized loan. So my son is a senior, but he's about to graduate. He was supposed to graduate this summer, 2024, but he has few more classes still left. So, because there were some quarters where he only took 3 classes instead of 4. So he has actually 1 more semester left, and we've been taking the federal unsubsidized loan for the 4 years that he's attended, and then he got a scholarship with a university that paid half the tuition, and then his father and I paid the rest. But my question is there a limit to how long you can go on this federal unsubsidized loan? Can he still apply for the final quarter that he needs to graduate?
Short answer is yes. The limit is it's not time-based, but there is an aggregate loan amount that you can take for these unsubsidized loans. So I believe, I'm just looking it up right now, and so it's for undergrad for a dependent student, which covers most people. It's $31,000 is the total lifetime amount that they can borrow. For their first year, they could have borrowed up to $5,500. For their second year, up to $6,500, and then for each year after that, up to $6,500. And so I just perhaps go back and look at what is the total amount that's been borrowed so far. And as long as it's less than 31,000, then they'd be able to borrow up to $7,500 for that final year or term.
Okay, that's good to know. Thank you.
Sure thing.
Shelley.
Thank you so much for all of your help. Looking at private loans and the protection, if a student, I believe that in a Parent Plus loan, if the parent dies, then the loan goes by the wayside. But if whether it's a Parent Plus loan or a private loan, if the student dies or is permanently injured, if the parent is taking out the loan, I've heard that there's some kind of protections that you can take. Do you know of the loans that maybe offer those? And the other thing that I've seen is that if you take out a private loan, if the student takes out a private loan and the parent is the cosigner, if they've paid the loan on time for 1 year, then the cosigner can be removed from that loan and no longer responsible. I'm just trying to see if you know about any of those loans.
This is a great question. It does vary a little bit from lender to lender. I'd say typically unlike federal loans, with many private lenders, the loan doesn't get discharged if if the cosigner passes away. In some cases, it does if there's death or disability of the student who was on the loan. But if you, I already have a note to somebody to pull together a list for this. So if you wanted to just email me at chris@joinjuno.com, and I'll type it into the chat right now. I'll make sure we get that list sent over.
Thank you so much.
Sure thing.
Patty.
Hi there. So I have a question regarding my daughter's going into her junior year in college and just declared education as her major. And I know that oftentimes there is loan forgiveness for teachers or students who major in education. And we have plenty of money in her 529 to cover her final 2 years in the education major, but would love to take advantage of the loan forgiveness that happens for teachers and save some of her 529 money for graduate school. And I'm wondering if you can share any insights or thoughts on that.
I think you're thinking about it in the right way. So the 529 plan, depending on how much money is in it, if let's say the student doesn't end up going to grad school, a good some chunk of it can be rolled over into a retirement account anyway. So there is some mitigated risk. But in general, if that's the direction educationally that they're going in, then I can certainly see why you'd want to preserve the option for public service loan forgiveness anyway. Now, granted, if their graduate student loans would likely also be eligible for public service loan forgiveness if they're using federal loans and going into a not-for-profit medical setting afterwards. So I'd actually kind of consider extending that same logic to all of the loans that they might take out.
Excellent. Thank you so much for that help.
Sure thing.
How about Suraj? Ooh, okay. How about we'll move on to Renard.
Hi there, Debbie, Chris. Thank you very much for taking all these calls, and we're getting a lot of great information here. Again, thank you very much. I've got two kids, twins, going to college this coming year, and I've got money enough in a 529 plan for 1 year for them. And my question is this: the 529 account, as far as I know, doesn't require any fees to place money in it. And money that's in there accrues tax-free, right? But now as I burn through the money that we have accumulated, I'm going to start to have to make additional payments going forward, in addition to taking out loans, which will probably happen next year. Is there any value for me to continue with the 529 plan if I am saving up money and just spending it right away for tuition? Is there any value in the 529 plan anymore? Because obviously I'm not going to be accruing anything for any length of time.
I don't believe there is. I'm trying to think through it to make sure that I'm not missing anything.
There is one value, and it depends on what state you're in. If you get any sort of state deduction from contributing to a 529, then you could and should still put your payment in and get the tax deduction, and then use the money. I mean, honestly, we kind of share this as a tip. You can put the money in like 2 weeks before you need to take it out. It doesn't. Well, I shouldn't say that. There might be in some states and plans like a time amount that has to be in there. So maybe check on that. But there's definitely a little bit of an advantage if you're in one of those states where you get a tax deduction for a 529 investment. So that's probably the only thing I can think of.
Yeah, I'm in California. I don't think I have any kind of benefit, tax benefit in that regard. So, okay, great. Thank you.
Bailey?
Yes, hi, just circling back. I was curious, is it possible to just accept the subsidized federal loan, or do you have to take both subsidized and unsubsidized? Thank you.
Great question. It absolutely is possible to just accept the subsidized portion. It might be, it can be a little bit more complicated because it's not necessarily broken out that way in what you're, well, it should be broken out in your master promissory note on your FSA account. One of the first things to do in a scenario like this is actually just email the financial aid office and let them know that that is exactly what you want to do. So for the first year of school, you could qualify for, I believe, up to $3,500 subsidized plus $2,000 unsubsidized. So I would just let them know that you want to accept the first $3,500 in that scenario of the direct Stafford loan that you've been offered.
Thank you. Do you know, really quick, do you know the breakdown for the second year when you can take out $6,500 total? How much is subsidized? How much is unsubsidized?
It's if you qualify for subsidized, but up to $4,500. So it might be less than that. It might be zero, but the max would be $4,500 for the second year. For the third year, for direct Stafford, you can borrow up to $7,500, of which up to $5,500 could be subsidized.
I don't know if Suraj is back. Okay, yeah.
Hi, Debbie. I'm sorry, I was fishing around for the unmute button. I couldn't find it.
That's okay.
Apologies for that. I had a question. Okay, I think you just answered the portion of the question for subsidized and unsubsidized loans. So, do you happen to know what the income limit is for a subsidized loan?
Income limit. Oh, okay. Go ahead,
Yeah.
Chris.
I don't, but I'm looking it up right now.
I don't think that there's an income limit because it's going to be dependent on each school and kind of what your need is at that school. That's why you might have seen, if you got multiple offers from different schools, that at some school you might have been offered a subsidized loan and another school you might not have.
Okay, understood. Okay. And what's a Pell Grant and a Stafford loan?
Pell Grant is offered by like a income or your SAI.
Okay.
Yeah, it's a grant that doesn't need to be repaid, and that is also based off of the amount of need that is calculated based on the information that you input into FAFSA. There's a formula that goes into it based on income and some other factors like household size that determines whether you're eligible for one, and if so, how much. We'll see if I can just pull up the link and perhaps post it in the chat.
So, Debbie, do I comprehend that every college application, the particular college would determine whether you qualify for a subsidized or an unsubsidized loan, right?
Yes.
Okay.
And there's a question here, so it's kind of similar to what you're asking, in that, first of all, every student in theory is eligible for the full amount of the unsubsidized loan, regardless of income, regardless of any financial situation. The only, maybe there's a few caveats. That one is you need to have filled out the FAFSA. And anybody can access those federal student loans. You do need to be like a certain number of hours or credits, going to school, and you need to have a grade point average of 2.0 and above. But so most students and families who fill out the FAFSA get access to the full amount. It's really the school that determines what the breakdown is between unsubsidized and subsidized. Chris, are you looking up income levels?
I just got it. I'm just posting the full link to the federal overview on federal Pell Grants, just in case it's helpful for anybody. There we go.
Thank you. And what's the Stafford loan?
So the Stafford loan is what we talk about when we say subsidized or unsubsidized undergraduate loans. Those are the ones that are taken out and the student takes it out in their own name. And for the first year of school, you can borrow up to $5,500 through that program, of which, depending on how much, let's say, your family's financial need, up to $3,500 could be subsidized. And so everybody can, as long as you fill out FAFSA, get access to that. And there's one little wrinkle here that might be worth mentioning, which is this $5,500 number that I've mentioned a few times. It actually is only related to what's classified as a dependent student. A dependent student is most students, candidly. The Department of Education has a separate definition for what is an independent student that allows you to borrow a little bit more money through this program. If you are denied access to a Parent Plus loan, then you can petition for your student to be classified as independent, and that would let them borrow a little bit more money through the Stafford program each year.
Oh, okay. I didn't know about that. That's excellent information, Chris. Debbie, you and your team do a wonderful job. Chris, thank you for your awesome response.
Thank you.
Thank you. Steve. Steve Perry.
Sorry, can you hear me?
Hi, Debbie.
Yes, yes.
I've
Oh.
sat on for a little while. Is it possible to ask a question at all?
Oh, how about let Steve go? Right.
Yeah,
And then,
mine's real quick.
And then you can.
Oh, lovely. Thank you.
Real quick, Juno, does the parent or the student sign up, or does it not matter?
It doesn't matter. It might be a little bit easier if the parent signs up, but at the end of the day, what you'll answer a handful of questions that'll just pair you with the right type of loan to apply for. And I would just recommend it. It's a little bit easier if you start it, and then when it gets to the part where say the student needs to fill out a portion to co-sign it, there'll basically just be a page where their email gets entered and their portion of an application is sent to them. But it doesn't necessarily matter who starts it.
Okay, great. Thank you.
Sure. Thank you.
Okay, who is the other person that you can unmute and ask away?
That would be me. I'm down as Renee Larby. That's my daughter's
Got it.
name. I'm Bandy. Thank you so much. I'll be really, really quick. In terms of the unsubsidized and the direct subsidized loans, is it? Some of my daughter's friends have been offered direct subsidized, but she's only been offered the unsubsidized option. Is there any reason why?
It's a good question. It's the formula for determining how much, if any of the amount it can be subsidized, is based on a lot of factors that you input into FAFSA. And so that is ultimately why. Now, there's one thing that can sort of change that, which is what you've input into FAFSA and the rest of your financial aid application for a school is sometimes based on slightly outdated data. So this year's FAFSA pulled in your tax information from 2022. And depending on when you filled it out, your financial situation might no longer accurately reflect what you had input when you filled it out. So if there has been any sort of financial change, especially if there's a change in income in the household, if the household has grown in size, or if someone has lost a job or you've incurred higher medical expenses, these are all things that are very worthwhile to tell the financial aid office about now, because there's a process through which you can appeal for them to adjust some of the assumptions they're using to determine how much aid you get based on SAI, which is the Student Aid Index. So I would just consider, if anything has changed, just let them know, because they might be able to make an update.
I see. So likewise, if I get a job during the year, if I contact the financial aid office as well, if that happened, would they then revise downwards?
I don't know if you want to, I don't want to know if you want to share that information. It's really, you want to share if things go the other direction.
Got you. Got you. That makes sense. And then my only other question was, if we take these loans, do I have to wait till graduation to consolidate everything if their, rates drop significantly, and we can take advantage of them before that? Do I have to wait till graduation?
It depends on what type of loan. So for private student loans, you do have to typically wait until graduation in order to consolidate and refinance. There's one or two lenders who are considering launching a program that might allow you to consolidate loans to a lower rate before the student graduates. With federal student loans, Debbie, do you know the answer off the top of your head? Double check
I would want to double check, but I remember once looking into it, and I kind of think it's the same thing. You can't refinance, or you can't consolidate until your student graduates.
It's okay. Okay.
Yeah, I believe it's that, or they drop the low half-time enrollment.
Right.
Yeah.
Got you.
Which, now as you bring it up, it isn't, I think, a product opportunity. It really honestly kind of sucks. Like if you have rates on a loan that you take out freshman, sophomore year, and then for something changes and rates really drop, you're kind of stuck with that loan for 4 years. It's kind of, it doesn't seem right, but
I can kind of answer that only from previous with my children. They were not allowed to consolidate till after graduation.
Yeah.
And once after graduation, they were like searching to consolidate, and they were able to.
Yeah.
Fantastic. Okay, thank you. And if they get any money from grandparents throughout the year, sorry, that's my last question. Does that affect anything at all? If money is given by family or does that impact anything?
Not anymore. It used to.
Okay. All right.
Yeah.
Lovely.
Let me just say one other thing, Renee. Well, actually two things. One is your comment about your student or your daughter didn't get offered the subsidized loans, but friends did. It really it comes down to two things. It comes down to what your SAI came out to be versus theirs. That's one thing. So it's hard to kind of compare with all the information. And the second thing, it depends college to college. So I don't know if it was at the same college or not, but in any case, it depends on what the school's total cost of attendance is, and kind of whether or not you were eligible for need-based aid. So that's why it varies school to school, and that's why it's hard to compare. The second thing I'll say is, though, again, depending on the school, depending on your financial situation, it can change year to year. So if that's again why you need to fill out the FAFSA. I don't know, depends on what your SAI is next year, depends on how much, unfortunately, the school's cost of attendance might increase. You may, become eligible in a different year. So it's not, whatever you're eligible for freshman year is not set in stone about what you'll be eligible for all 4 years. And that could go up and down. That could go positive and negative. And that's just something to think about with any sort of need-based aid that a student is receiving.
Perfect.
There's one small thing I'll just add on top of this that it might be a little too in the weeds, but if the grandparents are contributing towards your children's education throughout the year, it might be beneficial for them to pay tuition directly to the school instead of giving the money to the student in another format, only because direct tuition payments there's no gift tax associated with that. Whereas there is a limit on how much they would be able to give the children each year without accruing or at least being responsible for any transfer taxes. Now, the amount they give might not actually impact any of that, but kind of all else being equal, it just might be safer to have them pay some of the tuition directly.
Good to know. Thank you very much. Can't wait to have a look at the Juno platform. I'll be using it.
Great.
Thank you.
Thanks, Debbie.
Okay. Hudi, I don't know if I'm pronouncing that correctly, so I apologize if I'm not.
Hi. Hopefully you can hear me. I'm
Yes.
in a bad area. So I just wonder, I don't know how loan-based this question is, but I know that with the direct being need-based, right? but I have two kids going to college at the same time, and I'm the only working parent. I know they don't consider two kids going at the same time anymore. At least I heard that. But
Right,
is there
yeah.
anything I can do, like, that you can think of to get a little more
Yeah.
money from either of
Yeah.
these schools?
So for everyone's context, thanks for the question, because this is a really important point to discuss. So up until last year, under the old format of the FAFSA application, if you had more than one child who was attending college at the same time, that would be accounted for in what then was called your expected family contribution, or in other words, the number they calculate that says how much you probably need to provide as a family and support to pay for college. When that new FAFSA simplification started this year, that's no longer by default in the calculation that schools use. So they don't really care anymore if you have 2 kids or 10 kids going to college at the same time. That being said, your schools are still allowed to exercise something called professional judgment, which is a fancy way of saying they have the ability to adjust some of the assumptions about how much cost your family has and the model that determines how much you're going to have to pay. And this exact thing is one of the key things that you're allowed to appeal for and ask them to reconsider. Each school now has a formal process through which you can appeal your financial aid, and specifically your need-based financial aid, which is what we're talking about here. So I would absolutely let the school know that this is your situation. You'll be asked to provide some tuition statements for the other student at the other school. Not all schools will, let's say, be able to take this into consideration and provide you with additional money, but it should still impact, at least to some degree, your student aid index number and perhaps make you eligible for more federal student aid.
And how does that start? I mean, do I need to call the financial aid office of each school, or?
Great question. So each school is supposed to have a link on their financial aid website that includes instructions on how to submit an appeal and what documentation you might be asked to provide. If you can't find that in less than 5 minutes, then I would just email or call the financial aid office to ask for that specifically.
Thank you, guys, and thank you, Debbie. I've watched like almost everyone, and they're all, every time I learn something new. So thank you.
Yeah, glad it's helpful. Okay, Suraj, I don't know if you have another question or if your hand is just up from before.
Yeah, I have a question related to the grandparents 529. When the EFC was in action a couple of years back, the old FAFSA, I think if the grandparents contributed to the kids' education, I think it was advised that they don't contribute for the first 2 years, and they contribute towards the junior and the senior year, something of that sort, from what I recollect. To avoid, I think that income was considered as student income and taxed at 50% or something. That would reduce the EFC. Now with the new FAFSA, if the grandparents provide a contribution, would there be any penalties from the freshman year onward to the senior year?
I don't believe there are anymore. Let's just double check. Yeah. Money contributed by a grandparent for grandchild's education is not factored into the calculation of a student's financial aid eligibility.
Okay.
That is now correct. Yep.
And I believe that's only for a public college, but not for a private college. If it goes to a CSS profile,
right,
they want every bit of information in there, correct?
That's a possibility. You're right. So for a private college that uses a CSS profile, they still have the possibility and they have the right to ask that question. So
okay.
Yes, that's true.
Okay.
Yeah,
Debbie,
the grandparent held 529 plans are considered.
Excellent.
For CSS. Yeah.
Yeah.
Okay, excellent. And thank you for the answer on the previous question that Mr. Hooks asked. That helps a lot because I will have two kids simultaneously at some stage as well. And that's a good point to go back and talk to the financial aid office. So thank you very much for that. The last question I have, ma'am, is on the SAI. Previously, it was called EFC. Now it's called SAI, Student Aid Index. Is that a number? Let's say, how does the SAI go? I have no clue as to how SAI would reflect on screen for me. Would it be like 50,000, 60,000? What is the number? Or is it a single digit, like 1 to 10? What is it?
I believe it's negative 1,500 to 99,999.
It's I mean, they will say it's just a number. It's kind of like a dollar amount. The way you can check it is the government has a estimator, an SAI estimator.
Okay.
So I would just Google it and get the link directly to the federal one. If you're really interested, and it's actually not as complicated. They did have the act called the FAFSA simplification, and they did simplify it. There's actually, and I just don't have it offhand. I could probably look for it. There's a link to the actual kind of documentation of the calculation. It's 2 pages long. It's really not that hard. That's
Okay.
if people are a little nerdy, honestly, people have created spreadsheets. Excel, it's again not hard, and you can kind of do it that way, and that gives you the chance if you want to fool around and say, oh, what if my income goes up? What if my income goes down? What if I have this much in cash?
So I'll definitely look it up. So Chris, let's say SI comes out to be 20K. Okay. So would that mean that I would have to put in 20K every year towards a kid? Is that what it means?
Unfortunately, no. It's not actually indicative of what the out-of-pocket cost to pay for school is going to be. It's really just used as an index that helps you predict how much money you'd get from Pell Grants, and to some degree how likely it is that you'd get unsubsidized loans, and then very little else. The index number is in some ways used by, each school has a different size budget for how much need-based aid they can provide to students. And so it's more complicated than this, but they'll generally try to split up a lot of their need-based aid based on who has the lowest SAI first. But beyond it helping you predict Pell Grants and subsidized loans, which again, it's not perfect for, but it's very highly directional for. It's really just if the impact of it on how much money you'll get from a school will change from school to school.
Okay, gotcha. Thank you very much for the feedback. I'll definitely look up on the SAI calculator and see what it comes out to be. Thank you.
Sure.
Thank you, Debbie.
No problem.
I have a question when you have a second. I just can't find my raise the hand button.
Okay, go ahead. You can go, and then we'll go on to Teresa, but go ahead.
All right, thank you. So I'm just trying to figure out, I've heard a couple of things. Is the Parent Plus loan the loan that somebody can apply for, and if they don't get it, then the student can apply for it?
If a parent can't get a Parent Plus loan, then the student can be made eligible for a higher loan amount for the direct Stafford loan. So maybe just to reframe some of the conversations from earlier, there's 2 federal student loans that can be used for undergrad. And I'll just use a first-year student as an example. So for the first year, the student can borrow $5,500 themselves if they're a dependent student, which most are. Above that amount, if you want to use federal loans, then you'd try to get a Parent Plus loan. If you're denied a Parent Plus loan, then you can either get an endorser, which is effectively a cosigner who can make you eligible for a Parent Plus loan, or you can ask the student be allowed to borrow a higher loan limit from the direct Stafford loan, that first one we talked about. And if that's the route you go down, then they get to borrow up to $9,500 from the direct Stafford loan for their first year of school.
Okay, and then on your Juno page, do you have like Parent Plus loans versus Juno loans, or is it the same thing or something different?
We do have a calculator that just lets you compare any private loan. to what a comparable Parent Plus loan cost would be, and I can post a link to that in just a second.
Okay, thank you.
Sure.
Okay, Risa.
Yeah, hi, I have another question. I don't want to get into too personal, but my daughter has a health condition. Is there loans or some type of other free money that we can try to get to help reduce the cost?
So is she the student going to college or is she a sibling?
No, she's a student going to college.
First thing I'd say is make sure that the financial aid office is aware of any incremental, or let's say larger burden placed on the family financially because of the medical condition. It's something that's not often fully captured in the financial aid application itself. And medical expenses are one of the top reasons why you're able to appeal for more need-based financial aid. Have you done that so far? Or do you know if they have a full picture?
So they don't have a full picture because, and again, I don't want to get into too much, but I was told, we were advised that you don't have to tell what the condition of the health of the child is because they don't need to know. And I know my son went to another college and my husband unfortunately had a heart attack and he appealed because we couldn't financially and he got denied. But we have not said anything to the school because we don't know what kind of HIPAA law, are we allowed to say anything? Like what kind of verbiage can we use for this?
This is a great question, and I don't want to dive too far into something I'm not a complete expert
Can you
on.
reach out to me at another time then privately we can discuss it?
Yeah, happy to. Honestly, happy
Okay,
to.
how do you want me to send you my information?
Do you mind just emailing me at chris@joinjuno.com?
I'm sorry, what is it, Chris at what?
Joinjuno.com. JOINJUNO.
Debbie, can I answer that real quick?
Yeah, go ahead.
I don't know what you're talking about. My daughter has a diagnosed disability. So chances are, if your child had a 504 plan or special accommodations for things like the SAT in high school, there are medical-based scholarships through the state. I'm in Pennsylvania, through the Office of Vocational Rehabilitation. There's actually a book out there that you can look into that tells you how to go through the process. I forget what it's called, but it's available on Amazon. It's a skinny paperback, and it sounds crazy, but it works. It's part of the Americans with Disabilities Act. So if you qualify, it's something that you can look into, and it works. I guess
Okay,
they
so
work
we're in
for
New
us.
Jersey. Thank you. We're in
Yep.
New Jersey. Does that help? Is that for chronic diseases too? Or is that for just regular disability?
It can be for anything. I mean, the book talks about things as mild as asthma. You have to take a look at it, but it's a national program, and then it depends on your state what part of the state government you have to go through to figure it out.
She did have a 504 in through high school when she was diagnosed.
Yeah.
What is the name of the book that we can Google and get?
I'll have to look for it. Let me look. You know what? I think I lent it to somebody. Let me see if I can look it up while this is finishing up, and I'll try to
Yeah, because
post it.
actually, thanks, Steve. Somebody else
Yeah.
is asking in the chat for the name of the book.
Because if you want, I don't mind providing my email address. Like I really don't. Debbie has my email address as well. But Chris, I really would like to get more talking to you about the verbiage because it's important and it is I'm stressing out about how she's going to get for her treatments. So that's a big issue that I'm working on right now. So I'm stressing out with that. But I'll email
absolutely.
you.
Sure.
Okay, thank you so much.
And I'm sorry. Hello, my name's Lori, and this session has been wonderful. Every time I hear Debbie from you and your crew, I always get more information, and it puts me at ease. But I'm sorry. What was the name of the act that the gentleman had said, I'm sorry, I forgot your name. It was,
Americans with Disabilities Act. I just posted the link in the chat.
oh,
It's
Thank
called
you,
it's
Steve.
called the medical loophole.
oh,
Wow,
okay. Thank you so much.
Okay,
that's
thank you.
great.
I'm gonna take a picture of it. Thank you so much.
Mhm. Yeah, you can just click on it if you.
Yeah. Wow, thank you, Steve.
Very helpful.
Yes, thank you.
I'm not sure I'm going to pronounce his name correctly. Kashika?
Sorry, hold on. You did great. It is Kashika.
Oh,
Thank
okay.
you. I have a question. So we're a Michigan family. My son is going to school in Indiana. And even though we had, on the lower end of the SAI, we didn't get anything from the school outside of, a small scholarship. And his father has cancer, has had it for 12 years. And I've not shared that with the school. So I was just building off of, what she was mentioning and the other parent. So I guess I would call the financial office and first let them know about the family situation, but does that mean that they would then provide like additional grants of some sort versus like the federal aid, which we've already gotten, and our obligation is, huge because we're out of state. So I don't feel like our FAFSA has helped us. So we're going to be looking at loans just to, I guess, delay the burden a little bit longer. But I just wanted to check to see if there's something else that I should be asking or doing. And I will go on your site later, Chris. I got the
Sure.
link, so I will be checking that out as well. So thank you.
Unfortunately, I'm not quite sure if just sharing that your husband has cancer is going to make a difference. I think it's, do you feel that there were medical expenses that were not reflected well in the FAFSA? Which is usually the case because the FAFSA doesn't usually ask. I mean,
No, our medical expenses weren't included in that perspective at all.
So that's the reason why you should appeal. So as Chris commented earlier,
Right,
check out the school's process. You're going to want to pull together all of your medical expenses to show that you have this financial burden that really wasn't properly reflected through the FAFSA.
But
Yeah,
then
just to
do
make sure
schools
this is how
provide-
you go ahead.
Oh, sorry. So then do schools actually provide more, I don't know what they're called, grants or things in the financial aid
I
package?
can't promise 100% sure what the school will do. It's still up to them. I mean, I shouldn't say it's up to them. I mean, it may be that they're willing to recalculate your SAI with this new information. And because of the recalculation, you might then kind of fall into the area where you would be eligible for aid. I mean, that's really kind of the path that we're trying to go down.
Sorry, Chris, you were saying something. I didn't mean to cut you off.
No, just making sure this is for IU Bloomington. I posted the link to the appeal form that they have on their site. But it would absolutely make sense to either email or call them directly and let them know that there are significant medical expenses that are not reflected in your financial aid application. It's something they're used to hearing, unfortunately, and so they might ask you for specific types of documentation around the exact costs. What it could impact is, depending on how much adding that sways your SAI, it could make you eligible theoretically for Pell Grants or subsidized direct loans. And depending on what the school's general need-based aid budget looks like, could also qualify you for additional grants that the school might be willing to provide. It will depend a little bit on really how much money they have to work with, but also for future years, not just for this year. It's something that's worth keeping them updated on and including its additional documentation in future financial aid applications so that they can take that full picture into consideration.
And so his financial aid package included, a work study. It included whatever these loans were. I didn't really look at it in detail yet. So I think he's already been offered the federal grants that he's eligible for, or the maximum that you've been talking about. Beyond that, does the school provide other things, I guess? And that's what I don't know. So is the aid that you're talking about just getting more of the federal money, or is it the college specific?
College specific. So some schools do provide just general grants, effectively a discount to the cost of attendance based on financial need. And it's going to vary from school to school and year to year. But I'd say it's certainly worth trying.
Okay. All right. Thank you so much.
Sure.
We have one last hand raised. I honestly don't know if you've asked your question already or not. Allison P. Because I think that might have been from earlier. Chris, any questions that you see in the chat that maybe we didn't answer? There's one person that asked just a little bit ago about what's the rate that they should use when they're for the Parent Plus loan when they're comparing it against private
I'm sorry,
loans.
it's Allison. I couldn't find the unmute button.
Okay, no problem. Go ahead.
Sorry. My God. I feel like my question is super long and complicated, so I'm going to try to shorten it as much as I can because I graduated a long time ago and it took me 20 years to pay off my loan. I had gone through Citibank because that was what my mom's friend suggested at the time. I don't even know if they even still do that, but my daughter's yeah, okay. Well, it just so happens that today my daughter's going to be I'm in New Jersey, my daughter's going to go to Montclair, and today they had like a Zoom about the student financial aid period, and I didn't realize like this date is coming up where they're gonna present this bill and everything, so I'm like freaking out, and I'm just I feel I have a lot of credit card debt, and I just wonder if I would even be approved for any loan, and I kind of don't want to do that Parent Plus loan. I'm like, no one paid off my student loan. I paid it all myself, So I'm just curious also about, that we have New Jersey has like a HESA thing. So I don't know if what is better or worse to get. Is that kind of like a private loan? I'm kind of confused.
I never heard of HESA, and I also live in the southern part of New Jersey. So
yeah,
I don't
it's
know.
HESA. And it's also for like even for kids who are undocumented, they can apply instead of doing a FAFSA, they can do it that way too, I think.
What is the initials? Is it
HESSA? HESA.
HESAA.
Oh, something like that. Yeah, okay.
Yeah.
Okay, thank you.
You're welcome.
I'll have to look into that. That's another good one.
So my other question, so my part of it was like, should I add her, like, should I add my daughter as an authorized user on one of my credit cards before I even look for a loan? Yeah, I mean, I'm still gonna call the financial aid this week to find out. I mean, the Montclair's financial aid bursar or whatever it is, to find out exactly what I would be having to pay because she's gonna dorm and she wants to be a single dorm because she's an athlete.
So just maybe to summarize, are you concerned that you might not be able to borrow because of credit card debt?
Yes.
Okay. Chris, you want to comment?
Sure. So there was one comment about whether adding your daughter as an authorized user on the credit card would impact anything. But at this point, I wouldn't do that. That's not going to necessarily change the scenario. If the goal is to understand if you can get something that's better than a Parent Plus loan, for example, then you can do a soft check, so it won't impact your credit, just to see what private rates might be on the table, and then apply with the student to make sure that you get approved for that if there's a rate that you're being offered that you like. If you want to check out the HESA loan, they do have some pretty good options. In general, kind of depending on what your credit score is and what your debt to income is currently, it's probable that a Parent Plus loan could end up actually having a lower rate than what you might get offered from a private lender. But there's no way to know until you check.
What's the credit score that most lenders
I think
go below, Chris?
I have a good credit score considering it's like well, depending on, Discover says this number, the other one says that, but it's like between 675 on one to like 696 or something like that. So not
So
terrible.
that would still, I'd say it still meets the bar for the
Right, okay.
qualifications for most private lenders. That being said, most private lenders will it's less likely that you'll qualify for a rate below what you're getting offered through Parent Plus. If your score is, let's say, not very high. So that changes in some situations. And I don't know what the cutoff is for something like the HESA loan. I believe they might do a flat rate, if I'm not mistaken. So there might be a scenario there where, as long as you meet their qualification criteria, you get the same rate, regardless of what your score would be. So that might be a great place to check.
Okay. Because I am a single mom. I'm the one pretty much going to be footing this bill like I've done for the past 18 years.
Yeah.
Yeah.
I wish I could kind of tell you what interest rate the lenders would offer. I just, we don't know their formulas or calculations. But I think what Chris is suggesting is to at least do a soft credit pull, and that will kind of show you the range. And so you'll have an idea, is there a possibility of you getting, less than the Parent Plus loan or not?
Yeah, so like I said, this was just seemed to be like perfect timing of that meeting and then your thing tonight, because again, this was just, a general thing, and I didn't ask any question during it because I just really couldn't talk at the time anyway. I just want to, because sometimes I wonder how, maybe I'm just sounding stupid, but saying like, sometimes I wonder how qualified they really are, giving me the information out to a parent who's asking like, what's the best route should I really take for my situation? You know what I mean? If
It's
that
a
makes
good
sense.
question. I think the financial aid people know a lot about financial aid, but I don't, I'm not sure I know.
Maybe like saying like, I don't want them, I don't know if they just push you towards one thing or not, you know what I
Well,
mean?
I was gonna say, I don't know how much they know about
Right.
loans that are not federal loans.
Right. That's what I meant.
I don't think it's intentional. I just don't know.
Right.
How
Because
much.
it's like when you call a credit card and you give the wrong answer, and you call back, and you get a different customer service rep, and they give you better information than the previous one. You know what I mean? Like sometimes like who you talk to.
Yeah, no, I hear you, and that's why we try and keep, educate parents, because you got to do your own research at the end of the day.
Yeah, I mean, it's so much more complicated now, than when I applied for a student loan way back when,
Absolutely, I hear you.
Goodness. So thank you so much for taking my question. I appreciate it.
Yeah, I mean, definitely, check out HESA. You can check out, Chris, do you know offhand which of the other state lenders lend to out-of-state families?
I believe Iowa Student Loan, if I'm not mistaken.
Oh.
So it could be worth checking.
Okay, thank you.
Sure.
I will throw one thing out, but I honestly don't know if they have more funding left. I would Google interest-free loans.
Okay.
There is it's the Jewish Free Loan Association, which is a national organization. It's a nonprofit, and they offer interest-free loans. I don't have the details on the dollar amount. They also tend to have like a certain amount, and it might have run out. I don't know, but it's definitely worth reaching out and checking out with them.
Absolutely.
What is it? It's interest-free loans?
Yeah, here I found the link here. It's from the Jewish Free Loan Association. And I don't think you have to be Jewish to get the loan.
I am Jewish, so that's good.
Here.
That's only for the state of New York.
No, I know they've done it. They have in California.
Really?
Yeah.
Wow.
So there's the link. Oh, here, I'll give you an even more specific one. Here's their education link.
Yeah. See,
Okay.
I don't know if the student financial aid office would have told me this.
Not gonna tell us anything.
Okay, BB?
Hello.
Hi.
Hello.
I just a question that popped up in my head. My son is going into a pro pilot program, and I was just wondering how do I include how do I get a loan that will include his flight fees on top of the cost of attendance, because the flight fees are separate, and we don't know the total fees per semester because it would pretty much depend on his progress, I guess, and it's a pay-as-you-go kind of thing. Is there a way to include that somehow based on a...
So just to confirm, the school's official cost of attendance, are you saying that it requires the pilot training, but it does not account for the training fees, right?
Something like that. It's got a cost of attendance for just the major, but you have to pay separate for the flight fees.
Okay, it's possible that that might already be accounted for. And do you mind telling me the school, and I'll actually try to look it up and see if I have a hunch that there might be a version of it in a larger cost of attendance number that might be included.
Mm-hmm. He's going to Embry-Riddle in Daytona Beach. Yeah, because I think the cost of attendance is only for pretty much the major, the aeronautical science major that he's going to get into.
Got it. Okay. Let me take a look at this specifically, and perhaps email you, or if you'd like to email me, I can just make sure that we take a look at it. I'm dropping my email again in the chat, because I know somebody on my team spoke to somebody from the Embry-Riddle financial aid office about this exact question a few weeks ago.
All right. Thank you so much, Chris.
Sure thing.
Chris, does Juno have a soft credit check link?
Yes, absolutely. So once you create a profile, it'll take like 1 or 2 minutes. Then you'll have a link you can click on to check rates, and you'll be able to check with just doing a soft credit check. And then I just want to emphasize again, if you end up finding a lower rate from a very long list of other lenders, then you'd be able to submit something called a rate match request, so that we'd be able to, and honestly, we try to simplify it as much as humanly possible, so that we can match that lower rate and give you 3% cash back on that in case you don't like what you see.
Okay, and does it matter which parent applies, or do both have to apply if they're married?
Only one parent needs to apply, and I would recommend the parent with the higher credit score applies.
Okay, thank you.
Sure, thank you.
Suraj, do you have another question?
Yes, Debbie. Are there any specific loans for the state of Tennessee that could possibly be interest free, or at a better rate of interest for Tennessee for kids going into Tennessee schools?
Suraj, one question. What is your current state of residence?
Tennessee.
Okay.
Something similar to Brazo or HESA, something on those lines is what I was thinking.
Is it a Tennessee public school?
Yes, UTK, University of Tennessee, Knoxville, which is the flagship state school.
Okay. I'm double checking. We have a list of all of that. Off the top of my head, I didn't believe that there was
Yeah.
one, and I'm just double checking to make sure. I know Tennessee State has some very specific loan repayment programs depending on what career you enter post school, as long as you're willing to go back and work in Tennessee. Several states have programs like this, and they're typically associated with primary care and other medical careers. From what I'm seeing through our database, there's not a specific Tennessee lender, though.
Okay. Thank you. Thank you, Chris.
Sure. Sure.
Okay, well, hopefully this was helpful for everyone. It is kind of nice, like having questions live. Not that this is the, best topic that we need to discuss, but hopefully this was helpful, and we will send an email out tomorrow with the recording. We will have the link to Juno if you didn't get it tonight. Chris, is it okay? Can we put your email in there? Or,
feel free to.
Okay.
Sure.
So, because I know that Chris and his team are really helpful in answering similar questions like we had tonight. So I wish everybody the best of luck.
Thank you,
Thank you
Debbie.
very much for organizing this, Debbie. Thank you, everybody,
Thank you.
for the great questions.
Thank you both. Thank you, Chris. Thank you, Debbie.
No problem. Good night, everyone.
Thank you both.
Good night. Thank
Good night.
you.
Thank you both.
Good night.
Good night.
Good night.